Hi everyone, in this video we're going to analyze Starbucks and see whether the company is a good investment or not. First of all, Starbucks is a high quality specialty coffee and beverage company founded in Seattle, Washington in 1971. It's got 350,000 employees and 27,000 stores in 31 countries. So basically it's everywhere and definitely number one and the biggest coffee chain in the world. So now, where does their revenue come from? In terms of store type, 80% of their revenue comes from typical Starbucks store, and 11% from licensed stores, which you can find in supermarkets or airports. And geographically, 70% from Americas, including US, Canada, and Latin Americas, and only 20% from international. And product-wise, 74% from beverages, 20% from food, and only 1% from packaged single-serve coffee and teas. So these are the packaged coffees you can find in Kroger or Publix and bring home to make your own coffee in your coffee maker. So our first big question is, how has Starbucks done in the past years? To answer this question, we're going to look at three key things. 1. Revenue and net income. 2. Cash flow. And 3. Equity. Starbucks' both revenue and net income have steadily increased for the past 10 years, which is a great sign of their successful past business performance. In fact, their revenue has increased 15% on average, and their comparable store sales has also grown 5% every year. However, their net income did drop quite a bit in 2013 and 2019, but there were clear reasons for that. First, the company acquired Teavana to expand their business into the tea market, which cost them more than $600 million. And also in the same year, they spent a lot of money on their China development to grow their business in China. And most importantly, they also lost their litigation against Kraft, which cost them almost $3 billion. Similarly, in 2019, their net income dropped by about $1.4 billion from the previous year, but that wasn't driven by their poor business performance in 2019. Rather, in the previous year in 2018, they earned that one-time additional $1.4 billion from buying 100% of their East China joint venture. So if you look at the operating income in 2019, that actually increased from the previous year. Looking at cash flow has also been positive and steadily increasing for the past 10 years. But I'm not sure if you realize this or not, this cash flow chart is very similar to the net income chart that we saw on the previous slide. So cash flow dropped in 2014 and 2019 for the same reason why net income dropped in 2013 and 2019. So which were Teavana acquisition, a lot of spending on China development, and lost litigation against Kraft, and also that one-time additional $1.4 billion gain from the East China joint venture. On the equity side, equity has also been positive and increased steadily for the past 10 years, except for 2018 and 2019. So what happened there? So basically, the company borrowed long-term money from banks in order to repurchase their own stocks and pay dividends to the shareholders. So different from drop in net income or cash flow, this drop in equity could be a red flag going forward. So this should be watched out carefully. However, current debt to equity ratio is sitting around 60%, and rule of thumb is anything below 100% is considered okay. So I give it an okay for now, but this should be watched carefully going forward. So takeaway from the past performance, Starbucks has shown a solid business performance with increasing revenue and net income, cash flow, and equity. However, this long-term debt should be watched carefully. So now our next big question is, will Starbucks continue to grow in the future? And of course, the biggest threat to Starbucks right now is coronavirus. Because of the virus, less and less people are visiting Starbucks stores to buy their coffee. So to fight that, Starbucks is closing 400 traditional stores and opening up drive-through only stores. And also they're trying to expand their channel development, which sells single-serve coffee and ready-to-drink coffee in supermarkets like Kroger and Publix. And this is actually a great move for the company because this segment has a extremely higher margin than any other segment, and also only 1% of their revenue comes from this channel development. And for a company to continue to grow in the future, they need strong brand. And without a doubt, Starbucks has that. If you look at their customer loyalty side, they have almost 20 million rewards members, which has grown 30% over the past 2 years. And also, people love Starbucks not only for their coffee, but for the fact that the company cares about the environment and nature, and also they never hesitate to voice their opinion politically. And the most traditional way for Starbucks to grow is through store expansion. Surprisingly, there's still growth potential in the US, especially in the Midwest and suburban areas, because a lot of stores are still located in the West Coast as well as urban areas. And also, they've been recently trying to expand their international opportunities as they're entering into the China market and Italy. And when talking about future growth of the company, we cannot not talk about innovation and technology. And Starbucks seems to be very invested in those two areas. One good example is they recently launched door-to-door delivery through cooperation with Uber Eats in the US and Alibaba in China. And also their mobile app is very user-friendly. Their UI UX app service is great. Whenever you make your own coffee on your phone, you will find it really easy and convenient. And also, they recently hired Kevin John, who worked at IBM and Microsoft in Silicon Valley, which is a sign that the company overall is trying to go digital. And last but not least, Starbucks is trying to become more than just a coffee company. They're actually trying to enter into the financial market. A lot of people will be surprised to hear that because they would be thinking Starbucks making coffee, how can they do or engage in financial service? But that actually seems pretty feasible because Starbucks is already number two mobile transaction platform only after Apple Pay. So here's an example. You load $10 to your Starbucks rewards card and spend $5 on your double chocolate frappuccino today, but you're not planning to use that remaining $5 until next month. And until that next month, that remaining $5 is revenue to Starbucks, which is called prepaid money. And the company has more than $1.2 billion of prepaid money, which is just enough money for a small US bank to launch their branch. And now let's talk about risks a little bit. Of course, the biggest challenge to the company right now, as I mentioned earlier, is coronavirus. However, the company seems to be doing a great job of focusing more on the drive-through only stores and expanding their channel development. And also their current revenue stream geographically is kind of skewed because 70% of the revenue comes from the Americas, including the US, Canada, and Latin America. However, the fact that they're trying to pursue more and more international opportunities, that will help them solve this imbalanced revenue stream issue. And also the availability and cost of high quality Arabica coffee beans. The higher the coffee beans price, the higher cost the Starbucks has to endure. And here's my final thought. Looking at their past performance, Starbucks has a strong track record of increasing revenue, net income, cash flow, and equity. And also based on their strong brand and their attempt to go innovative and use new technology, and also their plan to go into the new market, the company seems to have huge growth potential, of course with manageable risks. So with all that information and analysis, I'm really confident that Starbucks is a great investment. However, their stock price is currently sitting at $86. So I personally think that's kind of high. So I'm planning to buy Starbucks if it drops a little bit. So I hope you enjoyed this video. If you like it, please hit like and subscribe, and I will see you later.